Good morning, everyone. It's Saturday, and we've just had a quite a big budget this week. This morning, the plan of action is we'll kind of go through the budget. I'm joined by Alex Hemshere, who'll introduce himself in just a second. And then we'll go over annual allowance and a recap of the taper because it's really relevant for McLoud. And then we'll cover these RPSS brown envelopes and in particular go over triage. And if people want to ask questions, they can do in the chat. You need to subscribe to ask questions in the chat. But without further ado, I will go over to my colleague Alex, who can introduce himself. Oh, I think you're on mute, Alex. We can't hear you.
Sorry.
That's better.
Yeah, try again. Thank you, Tony, and good morning, everyone. Just a very quick introduction. My name's Alex Hemshere. I've been sort of a specialist medical accountant now for 22 years, so man and boy. Been the sort of when the new GP contract came in, all this annual allowance stuff, CCGs being formed, PCNs, the whole lot really. So yeah, plenty of experience, and so we'll be able to take you through what I believe the main changes that affect the medical profession are in the budget.
That's great, thanks, Alex. And you've been a specialist medical accountant for 20 years, is that right?
22, yeah.
22 years, yeah.
Half my life.
So there's not a lot that you've not seen. Okay, so brilliant. So without further ado, I'll let Alex go through his slides on the budget, and then I'll cover some of the brown envelope stuff. Take it away, Alex.
Okay, excellent. If we could just go through to sort of like the main agenda, the points that I'm going to cover. So yeah, next slide and move along to the next one. And apologies to anyone here who's a consultant, but quite a lot of the focus will be on GPs because the biggest change in the budget was to the increase of employers' national insurance. And of course, all GPs are employers, they run their own businesses. So we'll focus on that first, but then there's also quite a lot on capital gains tax. There's some other areas of note as well. And also just to have a look at, it's all very vague at the moment, just to look at what their plans might be for the NHS and their spending review and some figures there. Okay, so next slide, please. Next one. Okay, so I mean, yes, the headline increase to the employer's national insurance, the rate increased from 13.8 to 15%, which was expected. What was perhaps not expected was actually the secondary threshold decreasing from 9,100 to 5,000. That's almost going to have an equal effect as the rate increase as well. What that means is that every employee that you now employ will be subject to employers' national insurance of 15% from £5,000 now. And so we've got then, it does affect people in different pay grades slightly differently, but you know, someone on national minimum wage, you've got an increase of about 2.8% of the overall cost of employing them. A practice nurse, sort of mid-range salary, about 2%, and then a salaried GP on 6 sessions, sort of at the higher end, around about 1.5%. But then we're probably looking at around about 2 to 2.2% as an average in terms of your overall cost, the increased cost to your payroll. Okay, if we go to the next slide. Now we act in the Forvis Mazars healthcare team for about 200 medical practices. They're predominantly in the Northwest. And the average staff costs were in 2023 about £78 per patient. By now, we anticipate it more to be, well, certainly over 85, maybe even touching £90 because of the increases in national minimum wage over the last couple of years. If we got a 2.2% increase to the overall staff costs, then that equates to about £1.97 per patient. The global sum, which is your main funding stream for GPs, being £112.50 per weighted patient at the moment. So if this is going to be completely covered off by the government and central funding, then is it going to have to be a 1.75% increase to cover this by our calculations anyway. And at the moment, we saw in the news yesterday, the BMA, RCGP have already raised this as an issue, and we believe that it's going to be a negotiation point for the new GP contract that comes in from April 2025. A lot does depend on the methodology that will be used by NHS England. There was a 6% public sector increase in 2023-24, again with the global sum increasing. but it was based on some historic data, which may or may not have been, sort of relevant to the modern world. In many cases, it did not cover the increase in cost for quite a lot of our clients. And also, it's important to consider that an increase to the global sum is a bit of a blunt instrument. It's just a pound per patient on an average across the whole of England, really, on England and Wales. So the weighted list is as a result of the Cahill formula. Some people get paid more, um, for more than what the patients on their actual list. Some people actually get penalised to get paid for as little as 85% as on their actual list. So where you are compared to that sort of does have an effect. Also, the structure of your business. If you have less partners and have more salaried GPs and nurses, then your staff costs may well be above the average. And so then it's going to be on an average practice basis. So it may not cover all of your costs either. And of course, there's going to be regional variations. We've given figures which we believe are fairly accurate for the Northwest, but you've got places like London and all sorts of around the country, there's going to be variations there. So it is clear from there will be winners and losers, even if they reimburse it as the profession as a whole and cover it. There's still going to be winners and losers from practice to practice. Okay, next slide, please. On top of this as well, we've also got the national minimum wage increasing from £11.44 to £12.21 per hour from April 2025. And this is an increase of 6.7%. So with the increase to the employer's NIC and also this national minimum wage increase, then we have now the cost of employing someone on national minimum wage who is full time increasing from 27,410 to just over 30,000. So that's an increase of 10% overall. It is quite possible that with the 6.7% increase to national minimum wage, because of the way that GP practices are structured with their wage structure and everything, this could give another further 2.5% increase on top of the 2.2% increase because of the national insurance. So we're looking at maybe a total increase of 4.7% for next year. This is before cost of living increases are considered for any of your staff as well, which hopefully, we would hope that some, but clearly not all, will be funded centrally, in my opinion. So it's easy to see, because of this sort of thing as well, GPs have been given, recommended by the DDRB, a 6% contractor pay increase. This is an actual pay increase for the GPs. GPs themselves will know that this is quite rare. It doesn't happen every year. It comes along every now and again. So it's easy to see a situation where there's an erosion of this from April next year. And if you haven't yet made any decisions this year about what the increments you'll give to the staff or how much you pass that on to your staff, then perhaps bear this in mind that it could actually see a little bit of a drop next year. Okay, can we have the next slide, please, Tony? Now, the employer's national insurance does affect people elsewhere as well. It can affect directors' salaries. So if you are also a director of a limited company, as well as your main role in the medical profession, you may, been used to paying the directors up to 9,100, which was, up to the secondary threshold, and you could pay that as a salary without it having any tax implications at all. No personal tax, but also no employer's NIC. That is now going to obviously change. A lot of the reason why people do it is because there's a lower earnings limit of 6,396. So as long as you pay a salary that is equal to or exceeds that, then it counts as a year for your state pension entitlement. If that was the reason why you were doing it, then in order to continue to do so, there will be a cost involved in doing so now. You'll have a little bit of employer's national insurance to pay. It's not the end of the world, but it is, quite annoying. There's other points to note as well. This increase will also affect primary care networks. So all the people on R's rolls, will the R's reimbursement increase to cover this? That's another question for, sort of the government and negotiations with the BMA. some GPs and others may pay casual wages to their spouses for secretarial assistance and things like this, as part of their personal business expenses. That level now might also be affected moving forwards, because anything over 5,000 will have a employer's national insurance charge, so a payroll will need to be run. And there's also, just to clarify something that was in, sort of the press and everything yesterday about employers' allowance, that has increased from 5,000 to 10,500, but it does not affect any public sector bodies, and this does include GP practices. So, you haven't suddenly become, sort of eligible for this. You're still exempt. You're still not allowed to. And
Yeah,
it also,
I saw that on Question Time, Alex, as well, because the government were implying that a minister from Treasury was saying small businesses are all fine, and that's including GPs. But if that was referring to the employment allowance, that's just simply not the case, is it? Because they're not eligible
no,
for the employment allowance, and so it appears that there's this kind of dichotomy that on one hand they're saying that they're private businesses and they're not part of the public sector, but then for the employment allowance they're saying, well, you do most of your work with the public sector, and therefore you're not entitled to the employment allowance. So they've got to decide which
yeah,
one of those situations it is. It's ridiculous to
yeah,
argue
indeed.
both, and I think that needs clarity really urgently, because I think a lot of GP finances are pretty tight at the moment, aren't they, Alex?
Certainly 2022-23, Tony, was a pretty rough year across the profession, and we have seen an uptick as well, and an increase for 23-24. And then it was starting to look, with a 6% increase this year, that it could be quite rosy, or at least much more stable. But then with this sort of issue on the on the horizon. And it's also a thing as well for GPs. The national minimum wage has increased now for a good 2 or 3 years, and that has largely been has been unfunded for GP contracts. They haven't had the extra funding to be able to pay for this. So that has had an impact on staff wages,
Yeah,
definitely.
and I guess it's not just people who are on minimum wage either, because obviously people will want to maintain a differential. So if you've
Yes.
got a receptionist on minimum wage, but then you've got a head receptionist on that plus £2 or whatever, then
Yeah.
people will want to maintain those differentials in pay, won't they? And
It
so,
does. It has a knock-on effect throughout the whole admin sort of side of things, to be honest with
yeah,
you.
I'll
That's what
shut
we've
up and let
seen.
you carry on.
Yeah. Yeah, it does, and so we have seen spiraling costs. As long as, I mean, the what we have seen in the last couple of years is that global sum has increased quite a lot to sort of like soften the blow there and balance the books. But it's whether that's going to continue past April. We would hope that it would do, and there's going to be negotiations. There's annual negotiations for that global sum figure. So hopefully they get that right. Just another thing on the employer's allowance as well. If you have a limited company and the only two employees, or only employee or only employees, are directors, then my understanding is that you do not qualify for the employer's allowance. However, if you employ other staff as well as the directors, then you do qualify for it. And so any employer's national insurance that is paid on behalf of the directors then suddenly does get caught, does get sort of caught up, sort of, sorted with all that. So that's just a little thing there. I guess the whole thing is that with this, the detailed policy with regard healthcare funding, we've got some big numbers that we'll go through in towards the end of my chat here about headline figures and everything. But there's no detailed policy yet really expected till the spring, where there's going to be a 10-year plan, which is quite an ambitious plan. Um, I've heard of 5-year plans before, but 10 years is a long one. So in the meantime, there's bound to be a little bit of uncertainty in the sector as a whole.
Yeah, I just think as soon as they get that clarity, though, that
Mm.
um, GPs aren't going to be out of pocket by this, the better, because I think it's just a really worrying time for GPs until that clarity comes, and so hopefully the government are listening to the BMA and the college and everyone else that's advocating that this needs to be clarified as soon as possible.
Yeah, and there is precedent on this as well, on a slightly different thing. But when the employers' contributions for the NHS scheme which only went up a bit, only from 14.3% to 14 to 14.3, and then again to 14.38. There was an increase to the global sum to cover that. So hopefully that the president's there and they follow the president. Okay. We've got a bit. The main changes after this were also to capital gains tax. This was where. So if we go on to the slide there, yes. So rates up until Wednesday were 10% if you're a basic rate taxpayer, or 20% if you are a higher rate taxpayer, and they are increasing to 18 and 24%. In fact, they did increase with immediate effect on Wednesday. If you have, CGT on second homes is remaining at 18 and 28% 18 and 24% respectively. What we've got now is, but there's also a thing called business asset disposal relief, and this will affect, it will affect people, GPs, consultants who've got limited companies and things like this. It's the old entrepreneurs relief, and basically, if you sell a business asset, step away from the business in a material way, there are, a 3-year sort of, time sort of gap for you to be able to do so. You could access an advantageous capital gains tax rate of 10%. Now, if you still want to access that 10%, that is only now going to be there until the 6th of April 2025. Business asset disposal relief will still remain. It's just that it's going to increase eventually in line with the basic rate headline CGT rate. So it's going to go up to 14% as from 6th of April next year. And then, eventually from the 6th of April 26, it's going to be at 18%.
Yeah, I think that's going to be quite a big deal for, I certainly know, I've got consultant friends who do a bit of private, and so, they, inverted commas, live off their NHS salary, and then, the profits are just kind of staying in the company.
Yep.
And so, 10 to 18%, if you can't get that disposal relief because you're a long way away from when you want to retire and finish private, etc., that's going to make a big difference, isn't it?
Yeah, and it was also a part. I mean, especially if they're financial planning and retirement planning and things like this. And what you can't do as well is you can't just wind a company up, access that 10%, and then start another one pretty soon afterwards. Sort of HMRC do not like that at all. So there's provisions to prevent you from doing that. So yeah, I mean, we can sort of talk about that. Yeah, yes, it will affect longer term decisions for those with limited companies who are intending to do this. That they might just have to have a think about what they want to do, and also just have sort of the long term planning. For GPs who have retired partners who it's quite difficult sometimes when a GP sort of like sells their share of the surgery premises. Before they've had 3 years, you've got to hopefully get a new partner coming in, which is difficult these days because a lot of younger GPs are not wanting to be partners. At the same time, you've got banks, solicitors, this, that, and the other. It can be quite a long, drawn-out process, and they might have been quite relaxed about it. Now, if they want to access that 10% rate, they have until the the 5th of April. So anyone who's in that position, current GPs who've got a retired partner, they might be a little bit more, okay, can we get a move on here? And then it's obviously going to be 14% and 18%. So it might just drive that forward a little bit more and have a little bit more of a focus in that. Just a little bit on capital gains tax as well. What we've seen is that the annual exemption used to be 12,300 for this year, and ongoing it's only going to be 3,000. It means that yes, more things are coming under the subject of capital gains tax. What people may not understand is that HMRC, there is a requirement if you sell something, even if you're not subject to capital gains tax, so there isn't any tax to pay, there's a de minimis amount that should be disclosed on a tax return that's 4 times the annual exemption. So that's only £12,000. So they want to know pretty much, you don't have to sell that much these days to basically have to make that submission. Okay, yes, we've got other areas of note. I mean, I'll just quickly run through these because, in terms of the tax bands, they are fixed until 5th of April 28, and then we will then start to have them see them having them increase with CPI again. That's neither an extension or a let off, but the stealth tax will remain that was introduced by the last government for another 3.5 years. There's no changes to EIS or VCT relief. IHT remains largely unchanged, with the nil rate bands and the residential nil rate band. There are changes to the APR and BPR. There's a total overhaul of the non-dom system, and we've got things like fuel duty frozen, tobacco duty continues to increase, sugary drinks, and so that's sort of like, a government sort of focus on prevention of like ill health.
And there was a change, wasn't there, to private pensions coming into in inheritance tax, but really important for
Yes.
listeners to realise that nothing to do with the NHS pension. So this is people that have put money in their DC pots, and previously, there was a kind of loophole that lots of people thought probably should never have existed, that people can then pass on their DC pot outside of inheritance tax.
Yep.
But that's not relevant for the NHS pension scheme.
No. Okay. On the next slide as well, on pensions itself, not much to say, which is good news, isn't it, Tony? No major changes, some much needed stability, but the annual allowance continues to be an issue. It's 60,000 a year. Tapered is still at 200,000. One thing that we thought may happen but didn't was a cap on the tax-free lump sum that remains at 268,275, I think, which is the old lifetime allowance rate. Lifetime allowance itself hasn't been brought back in. And yes, there is that thing there that April 2027 is the IHT thing for those, and yeah, I don't think it's going to affect people with NHS pensions who just, standard sort of like, leaving to a spouse or dependents, is it? A few other bits as well. Yeah, corporation tax rates remain the same. Stamp duty land tax on second homes is increasing from 3% to 5%. That actually happened the day after the budget on Thursday. This isn't a particular surprise to anyone, but there's VAT on school fees. With also anti-forestalling measures for anybody who did pay up front, hoping to sort of get out of that, then if they were between 29th of July and 30th of October, then they will be subject to VAT. VAT will be due on the first day of term that they apply to. So, the government are sort of saying, well, we're not going to allow you to do that. And there's also a change to the benefit in kind on electric vehicles. It's increasing, it's 3% this year, it's increasing to 4% and 5%. That will increase further to 7% from April 28 and 9% to April 29. But I've talked to someone who's in our sort of limited company team, and he says it's still going to be a good deal. So, okay. And then just a quick thing on the spending review. This is just like some of the government numbers that they had for the NHS. Additional funding of 22.6 billion from what it was at 23-24, looking forward to 25-26. So it's an increase in real terms of 4% annually. But if you sort of like break down some of the figures, I believe that this does incorporate some announcements that have already been made. So there's been a pay uplift for consultants, also 5.5% agenda for change. They were agreed in the summer. So we assume that those are included. The 6% increase to GP contractor pay was also announced in the summer. And they also announced in July that there's going to be an extra 1.8 billion to support elective activity and try and get waiting lists down in hospitals. So I guess the new stuff might be here. Capital investment is going to increase by 3.1 billion over those 2 years, which is 10.9%, average in real terms. Equipment upgrades and secondary care, 2 billion for information and technology system upgrades, which is probably what much needed throughout the NHS. Upgrade to 200 GP surgeries, but the amounts and timescales left completely blank. So they're just gonna. 200 probably doesn't even cover it. I can think of quite a few myself that need serious upgrades that they're leasing from NHS Property Services. And then also they always said they will continue to support the new hospital program, but again, specifics are unclear. So just go on to the last slide now.
Oh, sorry, wrong way.
On another one. So what we've got, the effect of the increase in employers' NIC on the NHS itself, I would say, that they reckon that there's going to be 23.77 billion expected to be raised, and then there's a memo underneath in their figures that 4.75 billion will be the allowance for impact on public sector organisations, the largest of which is of course the NHS. I don't know exact figures here, but I would say of that 4.75 billion, perhaps 2 billion of that relates to the NHS. Extra money that's going to go to trusts, hospitals, and things like that to cover the employer's nick. And because of the way that they've treated it, they haven't netted it off their figures or anything. So I would assume that the 2 billion is also included in that 22.6 billion also. What we've got for some general aims, and again, it's all like warm words at the moment without any specific policy, but they want to shift care from hospitals into the community. Local funding for social care has increased by at least 600 million, so that's a real increase of 3.9%. Transform systems from analog to digital, an emphasis on prevention, a real target of getting waiting lists down to 18 weeks as soon as possible, and there is going to be a 10-year plan, which is going to be released in the spring, full details of which will follow. Okay, and that's just a sort of quick thing about what we do as a healthcare team and what services we can provide.
Cool, that's brilliant. Thank you very much. So I'll just switch over quickly to my slide deck, and we'll just go over a few of the bits there. Slideshow from beginning. Why is that not showing? Do I need to kill that one? There we are. Perfect. So so thanks for covering that, Alex. So that's the budget as a wrap. So quite a big budget, but I think a bit of a sigh of relief that they didn't really make any changes to pension tax. But I kind of could qualify that comment in a minute. So just going to give a kind of quick overview of what is a pension and what is pension tax, because I think people just need a basic understanding of that to kind of understand what's going on with McLoud. So when I've talked about pension tax, when we used to have the lifetime allowance as well, I always used to kind of equate the lifetime allowance to a jug of water. So it was at a pension worth 1.8 million. And of course that went down to 1.07 million. And I say a pension worth because we don't have a pot in the NHS. So yes, we make quite big contributions and our employer makes quite a big contribution, but it's not going into a fund that's invested in the stock market. We're just paying in, and that's used to pay people's pensions in retirement now. In fact, there's a big surplus. It usually runs to about £4.5 billion a year. It goes in contributions, and that's just returned to Treasury because that's greater than the pensions in payment. But the idea of the LTA was to say, look, we'll give you tax relief up to a point, but if the capital value of your pension, and that was in old terms 23 times your 1995 pension or 20 times plus your lump sum, if you go over this 1.8 or 1.07 million, you can still grow your pension, but we're going to claw some back in tax, and quite a big tax. But then they also had a tax based on how much you could put in each year. So we were being taxed at the end, but now they were also taxing us based on how much we could put in each year. So again, this isn't based on your contributions or the employee contributions like it is with a traditional pension, but instead it was based on some kind of random formula on what the perceived value of your pension growth was each year. And so that used to be 255,000 back in the day. So, if we go back to, 10-11, when everything was at 1.8 million and you could put in £255,000 a year, no one had any tax problems in the public sector. And that's because these rules weren't put in for the public sector. They were put in for rich bankers who would squirrel, £1 million a year into a pension on top of their £1 million salary, and it was just a really tax efficient way for them to be paid. But then 255 became 50, and then all of a sudden, then public sector people started to be affected, and then 50,000 became 40,000. And then in 16, 17, they introduced this really stupid tax called the taper, which I'll cover in a minute, which reduced it as far down as 10, and then it was tweaked to go down as 4, and then thankfully it's back up to a minimum of 10 again. So to understand McLoud, we do need to kind of just cover what the taper is. It's a bit complicated. So you've got this concept on the x-axis called adjusted income, and so that's your taxable income plus this deemed growth, this the figure that you get on these annual allowance statements. And so if we look at the red line, this is what it looked like at introduction. So you used to have a general annual allowance at 40k, and then if you were over threshold income, which was then 110,000, which happened to be very close to kind of median GP and median consultant earnings, so lots of people were affected by the taper when it first came in, and then that could taper all the way down to 10,000. After lots of lobbying by BMA and lots of others, we then got this situation in 2020. So everything shifted over to the right by £90,000. So that took some but not all people out of tapering. But the sting into the tail to that was that rather than coming down to a minimum of 10,000, it came down to a puny 4,000. So if you kind of go back to that jug, if you're trying to fill a 1 litre jug with a 4ml syringe per year, it's impossible to do it in a tax efficient way. And then fast forward to the 2023 budget. So general annual allowance has gone up to 60, which is a big deal. And then that also changes tapering as well. And then they've restored it back to a minimum of 10, which was welcome, albeit we would have liked to have seen the back of the taper. So the taper is really important. So Alex has kind of covered in detail what did happen in the budget, but I was a bit disappointed with what didn't happen. We have a particular problem in this tax year, 24-25, because obviously this is the year where in all of the nations people have started to get their pay restored. Yeah, I wouldn't call it, the media will talk about big pay rises that were above, inflation busting pay rises, but what the media is ignoring is that our pay was hugely down, and so all that's happening is we're starting to restore our pay rather than it being an inflation busting pay rise. But in an annual allowance terms, it means that people like me, who are a year 14 consultant, I get a really significant pensionable pay rise this year, which will cause huge growth. And then so this green line, and I stole this graph, I didn't steal the graph, I made the graph, but I based it on something that the IFS had done looking at childcare allowances. So this green line is post-tax earnings. Yeah, so because this taxable income on the x-axis is all above the additional rate threshold, that's a nice straight line. So that's progressive taxation. That's a good thing, and that's fine. But then the yellow is minus the annual allowance. So you get this crazy situation where if you just tip £1 over 200,000 for somebody that's also in a pay rise year, like me, and then you get an extra £22,500 of tax for £1 extra income, which is clearly completely nuts and stupid. So it means for people in this situation, and this is a bit niche, but lots of people will be in pay rise years this year. They find themselves that they'll be better off earning just under 199.999 than they are earning all the way up to 242,000. So with 8 million procedures on a waiting list, or nearly 8 million people procedures on a waiting list, and West Streeting quite rightly wanting people to help out with that, just as they did when they were last in power and the waiting list came down. They've just got to be mindful that for some people it's going to be really difficult, because if they risk going over this tax cliff, it will cause them big problems. And none of this is helped by the absolute disgraceful position that pension admin is in, particularly in England and Wales, where people aren't being sent pension saving statements. It just makes it really difficult for people to plan. So anyway, moving forward, we need to do a bit of a history lesson to explain what all these brown envelopes are and remedial pension saving statements. And so if we go back to 2011, the beginnings of the coalition government, and Lord Hutton was tasked with looking at public sector pensions because he deemed, or the government deemed, that they were getting too expensive because we were all living too long. And so basically Hutton said, well, okay, we can't carry on with final salary at 60, which is what most people in the public sector had. So instead we moved over to care pensions, or career average revalued earnings. So it's basically based on your average pay rather than your final pay. That was really bad for medics, consultants in particular, because obviously they spent quite a lot of their career on relative low pay as a junior doctor, and then ended at a kind of high as a consultant. So consultants did really badly out of that versus GPs, for example, who were on care for their other part of their pension. And the reason why they've shifted it to state pension age as well, rather than this fixed age of 60, was that so we didn't need to constantly revisit this kind of longevity issue. So they've got a moving target of state pension age, and I'm quite confident, by the time I reach state pension age, it will have changed from what my state pension age is currently. And there was also this very complicated thing, which I'm not going to cover, called the cost cap, which basically meant that despite the narrative in some of the papers that public sector pensions are becoming unaffordable and very expensive, that's nonsense. The cost cap ensures that the cost envelope for pensions essentially stays the same, with a correction mechanism, so that the all of these new pensions came with a 25-year guarantee because of that. So
just a little bit on that, Tony.
Yeah.
Some people don't understand this. Actually, the employer's contribution rate is actually 20.6% these days. It's just that it all comes centrally funded by.
Correct. Yeah. In fact, that was in the last cycle. So with the current valuation, it's 23.7 or something.
Is it?
But,
yeah. Right.
Yeah,
Wow.
but roughly 9% of that flows back to the Treasury. So because of this 4 billion surplus, so the real cost, if you like, the real current cost in the NHS scheme is around 14%. So Lord Hutton told the government not to protect older members of the scheme, because otherwise there would be age discrimination cases, and of course government ignored them. And then this is why we have McLoud. So McLoud was a judge, and Sargent was a firefighter, and they brought cases in the Employment Tribunal saying they'd been discriminated against, and that went to the highest courts in the land. And we now have the McLoud remedy, and this is kind of the McLoud remedy on a page. So I'm going to do this in reverse, and I'm going to kind of fast forward to your retirement. So at retirement, you're going to be given a decision, yeah? So for your pre-2015 pension, everything is in your old scheme, the 95 or the 2008 scheme. After 2022, everything's in the new reformed 2015 scheme. And at retirement, you're going to be told or asked, what do you want this middle 7 years to be in? Do you want it to be in the old legacy scheme or the new scheme? And lots of people presume that they'll want it all in the legacy scheme, but actually it's much more complicated than that. But I'm not going to cover that today. So that's what happens at retirement, but they had to do something now. And so what they had to do now was remove the discrimination immediately, and they did that by rolling us all back into the old scheme. That's called rollback. And if you can remember back to that taper graph, everything has changed quite a lot in that 7-year period. So if we look at this 7-year period here, so this is 15-16 to 21-22, the taper's changed. We had a compensation scheme in 1920. The 15-16 tax year was before the taper even came in, and that was split into two so-called mini tax years. It's a bit of a nightmare. And so add on to this 7-year period, 5 years of carry forward. And then also, because they couldn't get all of this done by the end of the 21-22 tax year for admin reasons, they then had to bundle in 22-23. So we've now got a position where you've got to correct 8 tax years. So obviously normally if you use an accountant for annual allowance, they're only dealing with 1 tax year. This is much more complicated because they're dealing with 8 years. And tax legislation splits things into so-called in-scope and out-of-scope years. So basically an in-scope year is any year, the current year in the previous 4 years, and before that is out of scope. And so what that actually means is, for an in-scope year, and for this period, we're talking about 1920 through to 22-23, they're all in scope. That means if there's an increase or a new tax charge, you have to pay that charge. But if there's a decrease, you get a refund. So that's these in-scope years. But for these out-of-scope years, if there's an increased tax charge because of rollback, there's nothing to pay because that's out of scope. but they will still give you compensation if there was a decrease in your charge. So if we just move on to why these envelopes are so important, and they're really important because if you've had AA charges in the past, for most people, they will go down. So because of the budget was around Halloween, I had originally called this kind of trick or treat. So for most people, although these brown envelopes are usually a trick, this one actually might be a treat and might mean refunds. And this is why. It's a bit complicated, but there's three basic reasons why, generally speaking, your post-rollback growth is lower. So the first is that pay was trashed during that 7-year remedy period. And so the combination of pay erosion and the lack of something called negative growth, which we now have, but only from the 23-24 tax year, means that 95 growth generally goes down. There's obviously a difference in the accrual rate that you get between the two pensions. So the 1995 pension, you get 80ths of your final salary, and the 2015 scheme, you get 54ths each year. And it's the difference in those numbers which is the biggest reason why growth goes down. It's a bit unfair because they shouldn't just be looking at the accrual, they should also be looking at the retirement age, because the care scheme, you obviously, I can't get mine till I'm 68, which seems very unfair to measure it in the same way as the 1995 pension, which I can get in full without reduction at age 60. And then the last reason is about tapering. So I showed you all those changes to the taper, and that x-axis was the adjusted income. That includes the growth. So if you have a reduction in growth because of 1 and 2, then you also have a reduction in tapering, depending on your exact circumstances. But it can be higher. And so these are the main reasons why growth might go up. And obviously, if it goes up, you potentially have a charge. The first is a kind of pretty niche one, and that's for mental health officers who are consultant psychiatrists. They may get more double years. So 7 years potentially could be up to an additional 7 years on top of that. So that remedy period could be 14 years extra instead of 7 years extra. The 2008 scheme is also very different to the 1995 scheme. It's based on reckonable pay, which looks at your pay over a 10-year period with an inflation adjustment rather than best of 3. And also, I talked about this differential 54ths versus 80ths. It's much closer in the 2008 scheme. It's 54ths versus 60ths. So for both of those reasons, 2008 growth may go up. But last but not least, you know what I mean. If you have a pay rise and you've got significantly higher legacy pension, then you're going to have higher growth because of that. Because the legacy pension is related to your final pay. So if you have more 1995 and you had a big pay rise in one of those years, that's going to cause bigger growth. But do remember this bit about being in scope and out of scope. Yeah. So if you have higher growth in here, then that's out of scope for a new charge. Yeah, it might affect carry forward in these later years, but you won't get a charge in this period. So it's only these 3 years of the remedy period where you potentially get a charge. And if you're in England and Wales and you get a new charge in 1920, you can also do that against the compensation scheme.
Can I also add another why someone might increase as well if they're a GP?
Sure.
If you're a GP and you actually qualified as a GP between 2015 and 2022, your annual pension will shoot up a lot, but you could add big annual allowance charges as well, because essentially the GP thing is that your pre-qualification gets uprated to average GP pay, but post-qualification. But if that didn't happen before April 2015, then it just didn't happen for you originally.
Yeah.
And now when you go back into your scheme, it does. And so I've got some people who've gone from their 2008 benefits gone from 2,000 to something like 35, 40,000 now.
Sure.
Over that period. And so I guess the thing is, if you do get big annual allowance charges, the good news is it does mean that your pension's gone up a lot, but obviously you're not getting the full benefit of it, are you?
Cool. So we'll just move over to the brown envelope cam, and if I'll just change to this screen. Sorry, Alex, I don't think you're on this one. So if you've not got this piece of paper, you can get it from bit.ly/TG McLoud Triage, or scan that QR. And I'm just going to go through my RPSS. And so basically what they're trying to do in Triage, and so this is part of the HMRC digital service, is they're trying to answer these 6 questions. So I'll just show you my actual RPSS. It's just had a bit of information redacted. So just bump on page 1. Page 2 shows what's in it. So it's covering the 7-year period, plus it's also a normal pension savings statement for the 22-23 tax year. But it's not the 23-24 tax year because they say we'll send that separately, although they're not currently sending them at the moment. But that's a separate problem. We've then got this kind of nice table. So these are the new pension amounts split into the 2 schemes, but the calculator, the HMRC tool doesn't want the split amount, so wants the combined growth. And then we've got the old pension amounts split, and then these are the scheme pays amounts that I've paid. So I've paid a mixture of cash and scheme pays. The scheme obviously aren't aware of what I've paid cash, so this is just the scheme pays bit. So if you've paid cash, that might become important as well. This just shows kind of some of the more detailed bits, opening and closing value. You can see I've just highlighted this 1516 one because it's important for something called IP16, which was a way of protecting your old lifetime allowance. And you're all kind of saying, well, why are you bothered about the lifetime allowance? Because that's been abolished. But there's still protections available that will allow you to have a higher lump sum. So with that value there, in 1516 for you is above 826087, that means the capital value of your pension then was £1 million, and you can qualify for IP16, which you can Google. Nothing of huge importance on that page, and then we kind of get to the money page. Yep. So we'll just kind of go through these 6 questions very quickly. So have you paid an AA charge during the remedy period? So that's this bit here. So these red bits here. So I've obviously paid an AA charge. So for me, that's it. I need to make a full submission. If I didn't have anything there, I would then need to just go back and check my tax returns to see whether or not I'd paid any AA in cash. But most of you should be able to remember that anyway. If you've paid AA, most people have got the scars and wear the T-shirt and will remember that. Question 2 just asks you, have your contributions changed? Which is only relevant in the context of the NHS if you're a GP subject to something called annualisation. And so if you're not a locum GP, you're not subject to annualisation, so you can ignore that. Question 3, are any of your contributions higher in any year during the remedy? So what you've got to do here is compare these old amounts with these new amounts, and if any of them have gone up, then you need to make a full submission. So for me, all of them go down. So for example, 43 becomes 36, 51 becomes 44, 37 becomes 13, etc. They all go down. So from that perspective, I don't need to make a full submission, but I've already failed on this bit, so I still do need to make a full submission. You only need to fail on 1. Question 4 is your growth above 40k? And so for me, mine is just above 40k. So had I not already failed on this bit, I would have to make a full submission because it's over 40k. Is your net income above 190? So this is interesting as well, in that obviously the taper threshold is 200, and they've deliberately put a bit of a buffer in there, and that's because they want to ask you detailed questions about how you calculate your threshold income, and that's because they know that people have got it wrong in the past. And question 6 is kind of ultra niche. So this is for people that have got private pensions, DC pensions, that they drawn after 2015, but then have also carried on contributing into a private pension more than £4,000 in the 22-23 tax year, and that's something called the money purchase annual allowance. But if you've not got a private pension and you've not drawn it and carried on contributing, that's irrelevant and doesn't apply to you. So why is all this important? So if you fail triage, so if you fail on any of these questions, you can access free accountancy advice to go through the nightmare that is the HMRC digital service, which is over 200 pages long. So if you're a yes to any of these, if you've had AA charges in the past, if your growth is over 40k, if any of your numbers go up, or if you're potentially tapered in the 22-23 tax year, you can scan this QR code for more information, or this QR code to sign up, and you get up to £1,000, including VAT, of accountancy free of charge. So why is all this important? So if we just go back to the slides, which are here. So these were my numbers again. And for me, my growth is around 70k lower. And for me, that equates to around £32,000 in compensation. And I use the word compensation here a little bit loosely here because it's a mixture of cash compensation, which comes with 8% interest per year from HMRC, and what HMRC call compensation to the scheme, which I think is a bit of a confusing terminology because it sounds like they're paying compensation to the scheme and then you don't get it. But the reality is they're paying compensation to your scheme pays loan. So if your scheme pays loan becomes lower, then the amount of your pension decrease in retirement becomes lower. So you still get the compensation whether or not it's to you or to the scheme, if that makes sense. So triage. So I've gone through kind of that triage on a page, or of course you can do it on the HMRC digital service itself. If you do it on the HMRC digital service yourself, if you fail triage, you'll come to this page, which says you are eligible to use the Public Service Pensions Adjustment Service. This is kind of the warning page that you're about to go into the full tool. And if you go into the full tool, there's another 160 to 200 odd pages, depending on your circumstances. You need detailed financial information. There's lots of traps where you can get things wrong. And, like any human doing a 200-page form, there's huge scope for error and mixing up years, etc. So my strong advice is if you reach this page, is you qualify for free accountancy. So get an expert accountant to do this for you. So what help is available? So I've touched on this cost claimback scheme. So as per the rules here, if you need to get somebody to do it on your behalf, your accountant can do it for you, and you can claim £1,000, including VAT, per piece of advice. That means that this entire service could be free for you by claiming it back. So who are Forvis Mazars? So part of the reason why I partnered with Forvis Mazars is, firstly, I know them very well, but they also combine both accountancy and financial planning. So for something called contingent decisions, which I've not touched on today, you're going to need financial planning advice around that to decide whether or not, for example, to buy back service that you've opted out on and whether that's worth it for you, etc. For this bit, for sorting out 8 years of tax returns, essentially, that's the job of an expert accountant. They're the professionally qualified people to do that, and I would strongly advise that you use, an ASMA professional qualified accountant. And with the Forvis Mazars service, you actually get two accountants because there's two accountants in different parts of the process that will check over your numbers. So this, gone the wrong way. Let's use the keyboard instead. So this is the tool sped up greatly because it's over 200 pages long. So the process is obviously you have to go through kind of an engagement process, which takes a couple of weeks, like you do with any accountant. So they need to do all the kind of money laundering checks and ID checks, etc. Once you do that, Forvis Mazars will get all of the data for you that is needed from HMRC and the scheme, etc. They will check over that. They will feed it into these tools. At that stage, they'll be able to work out what, if any, compensation you due if you fail triage. They can then feed that into the HMRC tool using robotic automated technology, which is the stuff that I've built with them. And then that will spit out an answer from HMRC side, and they, of course, knew what the answer should have been at the beginning, and then that's all checked over by accountant too. And then they'll ask you if they, if you want them to submit that to HMRC to be able to get your refund. So if you want more information about that service, that's that QR code on the left. If you want to sign up, it's the QR code on the right. What I would say is that the deadlines for this are ridiculously tight. So for most people, the deadline, I'll come on to deadlines in a minute, is going to be 31st of Jan, which doesn't leave a lot of time at all. And I think there probably is going to be an issue with capacity in the sector. So particularly if you already have your brown envelope, I would strongly advise finding a specialist accountant to do this for you as early as possible. So what if you ignore it, and what if you've not got your brown envelope yet? So don't ignore it. So I always used to say to people with the kind of brown envelopes that were pension savings statements is no one is going to send you a bill. So under self-assessment rules, the legal obligation on you was to work out if you had a charge, and if you had a charge, to declare it through self-assessment and then to pay it, either cash or scheme pays. The kind of reverse of that, because this is a nice brown envelope, is no one is going to send you a cheque. So if you've got an RPSS, if you've paid AA charges before, you have to go through this process to be able to get your refund. HMRC are not just going to send me a cheque for £32,000. I have to go through the process to get it. Deadlines are a bit complicated, but the bottom line is if you've had an RPSS and if you've got any altered tax, and bear in mind the 22-23 tax year has never been assessed before, so a lot of people will, the deadline is 31st of Jan 2025, but it's different if you don't have any changes to tax, and it's different if you've already retired, etc. If you've not received an envelope, the deadline is 3 months from when you receive an RPSS. So what to do if you've not received one yet? I mean, this is a really difficult area. So I was promised, for example, by the then head of NHS pensions in 2000, that all of annual allowance administration was going to be in a self-service online portal by June 2020. There were not going to be any more brown envelopes. All the information was going to be there by June of each year, so people could do this. We were also promised by NHS pensions in England and Wales that these brown envelopes, the RPSS, would start flowing in April, which would have given the financial services sector 10 months to deal with this, rather than the now less than 3 months before the 31st of Jan 2025. So my view is if you've not had one, I would start chasing the scheme and asking them where it is, because what you want to know is whether or not you're in this group of 57,000 odd people where they've already done the calculations, the so-called automated group. And so if you're in that group and you've not been sent it, you should ask them to email it you as an unencrypted PDF, because they've already done the calculations and they've got it there in their systems. Or are you in the group that needs a manual calculation? Or are you in the very large group, particularly of GPs, where they've not even started to do a calculation because they've got missing data, courtesy of colleagues in PCSC and Capita, because we know lots of GPs have got missing data. But you really need to know which of those three groups you're in. So I would email the scheme and ask them which one you're in. Probably just worth saying as well is that on that original slide where I showed you those 13 years, it's actually 14 years, because the same deadline exists for the 23-24 tax year. And so you really need your RPSS and your 23-24 tax year to be able to self-assess for this year, which is, the deadline is just off 3 months, and to know if you've got any headroom, if you want to make contributions to a private pension, or you need to sort out your income because of tapering, etc., etc. So we're running out of time. So I will bring up the other screen, and we will move over to questions and answers. So let's just have a quick read of what we've got here. So Marta asks, should we all be getting a brown envelope? I've not received anything yet. So the answer to that is a little bit complicated. So who should be getting a brown envelope? A brown envelope should be going to anyone that's previously had a brown envelope during the remedy period, or anyone that's asked for a brown envelope during the remedy period. So if you exceeded the general annual allowance between 2015 and 2022, or if you asked for a non-demand statement, for example, because you were tapering, you should have been able to, you should have got an RPSS. So if you're in that group, so if you've had a previous brown envelope and therefore you're in the group that should be getting one, then kind of as per that previous question, you might just want to be chasing the scheme to see where you are. But if you're not in that group, or if you don't qualify for McLoud, so for example, you weren't in the pension scheme before 2012, then you're not going to be getting a brown envelope because none of this applies to you. So Martin, I was going to ask you a question there, Alex, but it's basically the same question. Should I be worried that I've not yet received my brown envelope? So, Nick, so question for you, Alex. Two questions on deadlines. Not had an RPSS or a PSS yet, requested twice. I've requested mine 3 times. I've not got mine either. Expecting compensation from RPSS, but uncertain about 23 and 24 years. So question 1, Alex, is assuming I miss 31st of Jan deadline for RPSS, how would HMRC know because of RPSS delay and allow 3 months grace? Will they start applying penalties on the 1st of Feb?
I don't know, to be honest with you, is the answer. The whole thing, the whole deadline thing. Firstly, anybody who's affected by this is a victim of age discrimination, essentially. So, I mean, this whole compensation thing, then paying 8% interest and this, that, and the other. If we go back, you had a bit of a time scale. You went earlier. I mean, that thing on the decision on the Court of Appeal was December 2019. We're now in November 2024. These have only just been released. We've got a deadline for some people of January 25, but for some people January 27. But obviously you've been working yourself, Tony, to try and push this deadline back. How strict are HMRC going to do? As I guess the thing is that they won't know necessarily when it's been released, so they would apply interest, and you'd have to ask an accountant in this instance to say, no, I only got it till then. I've got 3 months of grace, and appeal the interest.
Yeah, I mean, I agree with everything you've said. It's a bit of a joke, really. So we know what they did last year in the 22-23 tax year is they suspended AA for those affected, and they said we'll sort this out next year. And they said that because people didn't have the information to be able to work it out. And so it's exactly the same this year. People don't have the information to work it out. So we've got some people that haven't got the brown envelopes. We've got other people that haven't got the brown envelopes or have got it, and then they're asking the scheme for the 23-24 tax growth, and the scheme are saying that we're not producing them yet and there's no timescales for it. My personal situation is my local accountant down the road has basically said, look, you've got till Monday to commit for this tax year if you want us to do your self-assessment this year, which, I've not got the paperwork. So, I think the technical answer is HMRC saying you should estimate it. The practicality is that estimating it is going to be almost impossible for most people if they've not got those preceding 15 years.
Yeah, I mean, it is difficult. I mean, certainly what it's doing is that essentially for consultants who have been used to getting their pension savings statements on time, bringing them into the same regime as what it's been like for GPs who have never had theirs on time, because the pension certificates that it's based on are always done after the tax return anyway. But then, we are able to produce estimates for our clients, consultants, or GPs, but it's not an ideal situation to be in, and then you have to go back and amend it and everything like that. It's creating a huge amount of issues.
Yeah, and it's probably worth saying lots of people are advocating for them to push these deadlines back. So the BMA have written to the Treasury Minister asking them to push it back into HMRC. I know the CEO of
solution.
Sorry,
common sense. It's a common sense solution to push it back. If you've got a refund, they said it's got to be done by January 27. It's like, can we not just make it January 27 for everyone then?
So I think it's a watch this space, but as of today, the 2nd of November, no extensions have been given, and technically you're meant to be estimating it. What I'm putting on my tax return, or what I've told my accountant to put on my tax return, because I've not got the proper paperwork yet from the scheme, is I don't think I'm going to have a charge, but if I do, I'll use scheme pays. But I can't, tell you accurately until I get that paperwork.
There's a lot of white space entries going in at the moment, which is the white space is what HMRC, any box, anything we need to know about your tax return. This has been done on a provisional basis. If we have estimated annual allowance, then we'll say this is an estimate. If we can't assess at all, to say, look, we just don't know. We'll have to go and revisit this later on.
All in all, really unsatisfactory, I think, to be putting members through this. As I said, RPSSs should have started flowing in April. We were promised 4 years ago that PSSs would all be in an online portal by June of each year. And here we are in November. It's 5 months after June. There's no online portal with AA information in, and there's no pension saving statements, and there's no timescale for it. I think it's a pretty poor show, personally. Anon asks, in regards to the fees for services by Forvis Mazars, do we pay them first and then claim them back, or do they claim on our behalf? Can somebody guide? So, yes, we did actually ask the scheme, would it be possible for Forvis Mazars to be able to bill the scheme directly, so no one was out of pocket, and they came back and they said no. In fact, I'll read you what they said. Throughout the scheme rules, it states that there has to be a loss for us to compensate for. If members are not paid for the service, they, under the scheme rules, have not yet received a loss. The cost claim back service has been set up for the member to be able to claim back for their appropriate losses, and we have not agreed with any provider to deal direct with them and not the members directly. So under the scheme rules, you've got to pay for the accountancy fees, and then once you've done that, Forvis Mazars will then deal with the scheme to get that paid back to you directly. So overall, you're not out of pocket, so it's inverted commas free, but you do have to pay up front and get it back, because them is the rules. Probably worth adding that the cost claim back service is in England and Wales, and we're still waiting for confirmation of exactly what's happening in Scotland and Northern Ireland. But generally speaking, all the schemes tend to mirror each other, but we're still waiting for the detail on that.
Yep.
So, a question for you from Ed. Thanks for doing this. I emailed a request for an annual allowance statement, and NHS Pension said they can't provide this, and we'll send an RPSS, but they can't provide a timescale. No idea what to do. So we kind of covered that already, actually, haven't we? Yeah, really unsatisfactory, Ed, and I feel for you, and I'm partly in the same position because I've not got my pension saving statement either. But fair not, because you've got that 3 months from when you receive it.
Tony, is there any reason why they're insisting on sending out by post when we have a My NHS pension portal?
Well, yes, there is a reason. I'll try not to use too many expletives because there might be children, in the background, and NHS pensions are massively under-resourced. Yeah, we are the biggest DB scheme in Europe. We're by far the biggest by far the biggest pension scheme in the UK, but they're running it on a tiny budget at 0.08% of a pensionable pay. Peer public sector schemes in the UK are doing admin costs that are way higher than the NHS scheme. So they've run it for a long time on a tiny budget. And because of that, they're way, way behind where they should be. As I said, Chris Dawson, the then head of NHS Pension Service back in 2020, promised me that all of this was going to be in the portal by June 2020. And admittedly, that promise was made just before the pandemic. And obviously the pandemic put things back. But even after the pandemic, or at least after the first wave of the pandemic, Chris Dawson again re-promised that all of this was going to be in the pensions portal by the 21-22 tax year, by June of each year. Again, not there. Kind of worth pointing out as well at the time, one of the biggest problems that we had, and as per Ed's question and lots of other people's questions, is people want to know if they're not going to get one, why they're not getting one. And so Chris had promised as well to put that in the portal. So for example, it would state, you've not got one because you need a manual calculation, or you've not got one because we're waiting for employer data from PCSC. All of that hasn't happened. It's very disappointing. There's lots of people in the BMA and elsewhere who are jumping up and down at it, and watch this space. But it's really poor. Kate asks, I've been told by NHS BSA there is a pre-assessment error on my account. I don't know what a pre-assessment error means. My 23-24 statement has not been sent yet. I hit final increment last year. Worried big tax charge. Any advice? I'm not sure I know what a pre-assessment error is. Do you, Alex?
No. I can try and find out. I'll find out, and
perhaps we'll come back to you, Kate. But the bottom line is, I hit final increment last May, worried re big tax charge, any advice? Unfortunately, we just kind of have to take it on the chin. So I hit final increment in September, just gone. So the combination of that and the DDRB uplift and then the back pay means that my pensionable pay is going to go up really significantly this year. I'm going to have a huge tax charge, and because I've already exhausted all my savings with previous AA tax charges, I'm afraid it's just going to go into scheme pays. The one thing I would say is definitely don't come out the scheme unless you've had financial advice to do so, but you'd be wasting your money on financial advice, because I don't think many financial advisors out there would tell you to come out the NHS pension scheme. So you're going to get a big tax charge because your pension has gone up significantly. And so that's the bit that you've got to remember, particularly for these kind of proper pay awards, where you kind of more or less guaranteed to have that pay when you retire. That is, you just need to pay it. Alex and I were just having a chat before we went live, and he's got a friend who I think is quite young, and is got a management salary. They're the ones that I worry about a little bit more. So if you get like a big promotion and then your pensionable pay goes up a ton, and then you get a huge tax charge because of that, you've then got to make sure that pay is there within 3 years before you want to retire. So those people, I definitely have got friends who paid big tax charges on promotion, in their late 30s or early 40s. But then you're kind of committing yourself to be in that role when you want to retire. And that's a big commitment to make. So I'd just be very careful, thinking about pensionable pay rises early on in your career.
Yeah, it's also the case is if anyone does a lot of extra waiting list initiatives and things like that, which are treated as pensionable. I think a lot of them are treated non-pensionable these days, but at times people have done extra pensionable work that comes into your pensionable pay. It's just like, yeah, but is that what you're going to retire at? Because if it's not, you're paying
that's worth picking up on, actually. So if you're less than full time and you do WLI at flat rate, then that can become pensionable. If you're already full time, then WLI shouldn't be pensionable. But we are in discussions with the scheme about whether or not it should be pensionable in the 2015 service, because particularly if you're getting flat rate for stuff, and this also applies to consultants for additional PAs, for example, it becomes your worst rate of pay. So additional PAs are paid less than normal PAs because you're not getting them pensioned. And so our view, BMA's view, is that we would like to talk about those things being pensionable in the 2015 scheme, but not in the 1995 scheme, because that will cause a bit of a nightmare for annual allowance, because obviously it varies. What are the contact details are to chase an on-demand statement? I'll put those in the show notes afterwards. At least I will for England and Wales. I'm not sure I've got all the contact details for the other ones. Harish asks, an RPSS error results in zero tax liability. Why should a member correct it and risk a tax charge from the corrected statement? How useful is the NHS BSA Ready Reckoner? Do you want to pick that up? And I might come in on the NHS Ready Reckoner after that. So if it results in zero tax liability, why should a member correct it and risk a tax charge?
Right. So what? An RPS has been issued and we think it's wrong, but it is saying zero. Yeah. Well, how it's like with any, I don't know. I mean, I couldn't possibly advise someone to just go along with something that was wrong. It's but a personal decision. But you'd be having to chase the NHS pensions, NHS BSA, to say this is incorrect. I want to pay more tax.
Yeah. So the part 2 bit was how useful is the NHS BSA Ready Reckoner? I work closely with colleagues that have written that, and I've got great respect for them. But unfortunately, it's not that useful because, on the front page of that Ready Reckoner, it will tell you that it's all kind of pre-McLoud, and so it's not post-McLoud, which makes it a very limited value. The other thing that I fed back to them as well is that they updated it in October, so only a month ago, to do the 24-25 tax year. but people also need the 23-24 tax year, not least because the scheme in England and Wales are turning around and saying things like there are no timescales for production of that. And so people need all the information about McLoud. So they need their RPSS, they need their 23-24 PSS, and they need to know what the taxable income is going to be to make a sensible decision about this year. So,
Yeah.
the
I mean, I
government
suppose,
agencies are putting
yeah,
people in a really difficult position.
the only thing I suppose I would possibly say about 23-24 is because of the way the calculation works, you can get your previous year closing figure uplifted by 10.1%, which because that's what the inflation figure was in 22-23. So obviously, whatever your income is in your 2015 scheme now, and if it's quite high, you will have quite high growth. But if you haven't had much of a pay rise in 23-24, I know some, you're going to get one in 24-25. We will see, I think, for a lot of consultants, negative growth that you can now offset for 23-24.
100% agree, and that's the basis that I've told my accountant,
Yep.
to in mind to put that I don't think I'm going to have a tax charge because I know that I'm going to have big negative growth. So,
Yep.
negative growth is something that I've been banging on around for 7 years and was
Yeah,
campaigning
we
heavily
annoyed
about
us
it,
as
and
well, Tony. Yeah, definitely.
and calling it pension theft because it literally was the government stealing your pension by zeroing off negative growth. But I'm really grateful that the government listened to the BMA and HSA and ASMA and all the people that lobbied for many years to get negative growth included. But it's really important, and it's going to be really important in the 23-24 tax year because our pay was destroyed in that tax year. So in that tax year, you're allowed, as Alex just said, if your pensions go up by 10.1%. For consultants, we got 6% DDRB, and if you've got CAs, it's going to be less than that. So I'm going to be 4 or 5%. So that meant that my pension in 1995 terms went down by like 6-7% in that year. So I have an enormous negative growth, which can offset my 2015 growth. So I'm fine. And actually, people saw my scheme pays history. I've had tax charges every year for forever now. And 23-24 is going to hopefully, touch wood, be the first year that I don't have a tax charge. It can actually generate quite a lot of carry forward. But that's going to be short lived because I know 24-25 is going to be very painful.
Yeah, and also as well, people might want to know 23-24 for all sorts of reasons. Say, it'll be a case of like, well, I want to know my carry forward because I've got a high. I want to know what my position is going to be this current year, and they're asking me to do extra work or this, that, and the other. I'm close to taper. People have got all these decisions to make, and this, that, and the other. And if they don't know exactly where they're at, then they can't make those decisions.
Yeah. So Caroline asks, do you have a list of the documents that will be needed for Forvis Mazars to do the work so I can collate them now? And I've filled in the inquiry form. So basically, you don't need any documents to fill in the inquiry form. Ideally, you should have your RPSS because that's the most important document to get going. But beyond your RPSS, Forvis Mazars will do everything for you. So they'll onboard you, they'll do all the money laundering, ID checks that all accountants have to do. They will ask you to sign authorities so that you can get information from the scheme and HMRC, and then they will get all the information that they need. So you don't need to be digging out tax returns and blah, blah, blah. They'll do all of that for you. So it's meant to be kind of an end-to-end process that makes it as minimal hassle as it possibly can be. Is that right, Alex? Missed anything
Yeah,
else?
it is. Yeah, I mean, there's a bit of a questionnaire because obviously there's a bit of fact finding that we need to do. Ask a few questions. You're a consultant or GP because that changes things, and these sorts of general questions. Hopefully, it's fairly light touch.
Yeah.
And there's also a bit of sign up, a bit of sort of forms to sign and things like this. But yeah, once it gets going, then essentially it gets through the system. We get the information back, goes back through this robot thing, gets checked, and then you get a response from us as soon as we have it, basically with your final position, which
Cool.
should be along the line of what you're expecting. If there's issues that we find, then we will flag them up and contact you directly.
Cool. Eleanor asked, how do you prove when you receive the RPSS if it's so late? Not had mine. So this is really interesting, Eleanor. So my RPSS was, I'll just go over to it, brown envelope cam if I can find it. Is it this one, isn't it? Yeah.
I guess what might be, yeah, sorry to jump in here, Tony, I might be preempting what you're saying anyway, but what might be really unhelpful for Hemshere's pensions here is if they did a bulk run, say 7th of October, and then sent them out, so they're all dated 7th of October, and then send them out over a period of a couple of months, because that
Yeah.
is going to be really unhelpful.
Yeah, well, and I think that's exactly what I mean. I don't know whether the couple of months bit is right, but worryingly, mine was dated the 3rd, and I didn't get it for a couple of weeks till after the 3rd. And I know second class post isn't great, but it shouldn't take that long. And so I think they have done bulk calculations, and so the date on here might not be the date that you get it. So, I would definitely just kind of record the date that you receive it, and to make sure that you keep onto your 3 month deadline from when it was actually issued to you, not necessarily the date that's on it. So I did another session with one of your colleagues, Alex. He's a financial planner, and as I said, one of the reasons I went with Forvis Mazars was because they do planning, which is kind of forward looking, whereas accountancy is generally kind of looking at the current tax year. And Kevin's asked a bit more of a planning question. So with an 8k management allowance, I don't think I want to keep doing till age 60. Might it be worth partially retiring age 58 to 59 as long as it's in the last 3 years? So what I would say to that is the way that they do best of last 3 years means that you would have to be earning that for the 12 months within your last 3 years. Yeah, so you can't just kind of stop it and then retire 3 years later, because then that would have been completely out of it. So it's 2 years, if you like, after when you lower that pay. So definitely an option, but that's kind of more of a financial planning question, because
I think there is. I think there is a thing as well. If you change to a different role,
pay
you can
protection.
protect.
Yeah.
So
yeah, I mean, pay protection is definitely an option, but pay protection has an element where your employer has to agree to it as well, and so you can't completely rely on that. Because you don't know whether or not you're going to get pay protection. It gets complicated. There's lots of rules around it. That's something for a planner to advise on, because you've also kind of got you talked about partially retiring age 58 or 59. So there's kind of another two elements in there. So one is going to be if you go at 58, 59, there's a early retirement reduction for both the 1995 and the 2015 schemes. And then the other option is partial retirement. So again, with partial retirement, ridiculously in my view, your employer has got to agree to that partial retirement. Very unfair. So Alex, I'm sure, has got a private pension, because I'm sure he might like the NHS pension, but he's got a private pension in the private sector. And if Alex wants to draw down his pension, he can do that whenever he wants without the permission of his employer. So why we've got to kind of go through this ridiculous process to access the pension that we've been paying into all our careers, and then get our...
I think probably because you've got to take a cut in pensionable pay, which means you're getting a cut in hours. So you can't just force your employer to say I'm working less hours.
But again, that 10% reduction thing is slightly ridiculous, and we argued it was slightly ridiculous, and it only existed because in another part of the public sector they had this 10% reduction, and I personally think it's a very silly rule. So lots to consider there, Kevin. So Kevin also says, can you use Forvis Mazars for this but stay with your usual accountants for tax returns? And the answer is yes, and that's exactly what I'm doing. So these 8 years are being done outside of self-assessment, because the government knew it would get very expensive if people had to go to their accountants and get them to do 8 years of correcting their tax returns. And in fact, because 4 years are out of scope, they couldn't have done that through the self-assessment process anyway. So this is a completely separate process. You can do it. So what I'm doing is, I'm going to use a specialist service like this for the HMRC, claim back, and I'm going to get my £32,000 compensation. But for the moment, I'm sticking with my current accountants for my 23-24 tax year, because they've always done it for the whole of the remedy period. They've got all my stuff. They've got access to my zero and all the usual things. So they're two completely separate things. And I think a lot of people are going to be doing that, not least because, I've no idea who your accountant is and whether or not they're a kind of an ASMA specialist accountant, but this is ultra specialist work now. And I don't think a lot of local accountants are going to be geared up to do this and to interface with this horrendous 200-page HMRC digital service. So I think the answer to is absolutely yes. You can use your accountants for your tax returns, and then do this as a separate process.
Yeah, just a little bit on that as well. Just we will be asking for your authority to liaise with HMRC on your behalf, but just on this particular thing, and that's all. So normally you'd fill in like a form 64-8 for your someone to be your tax agent or your tax advisor. That will remain in place. So it's just this small bit of work that we're doing. Well, not small, but this bit of work, and that is the limit of our engagement.
Cool. So we've gone way over time, Alex, but because we're enjoying ourselves talking about pensions and pension tax, so we'll make this the last question. Mary asks, I got my second last increment in April 23 and then bumped up again this year with a change in increment dates. I assume I will have a tax charge in both years then. I'm very worried about 24-25. So because I wear this t-shirt, I'm going to answer this one, Alex.
Okay.
Yeah, I think I would be worried that you do have a tax charge, Mary. But what I would say is don't worry about it. And so, I know, and I'm not going to say online how big my 24-25 tax charge is, but it is enormous. Yeah, it's going to be a very large number. But I've just resigned myself now to the fact that any current or future tax charges will have to be scheme pays, because I've exhausted savings, and scheme pays is a tax efficient way of meeting a charge, and I don't have an alternative. Now, of course, I'm going to carry on lobbying that annual allowance is a ridiculous tax in DB, and I'm going to carry on lobbying that the taper is the most stupid tax ever done. But I don't worry about it in the same way that I used to worry about it, and I've just resigned myself to the fact that the tax charge will be what the tax charge is, and I will scheme pays it. So don't worry about it. There's not a lot you can do about it, and the bit you've got to remember is that if you've got a big tax charge from AA, then it's because your pension has gone up significantly, and so you've got to remember that there's benefit there at the end of it. Particularly for these kind of increment things. These are real pay rises. This isn't the Kevin example of having a management allowance and then having to worry about whether or not it's going to be within his last 3 years. This is burnt into your proper pay, and so try not to have nightmares about it, because I think lots of people are going to have a tax charge in 24-25. We can't stop fighting for our pay to be restored, because it's going to cause some tax charges. We've got to try and get our pay back to what it was, and not worry about it. Alex, is that a fair view?
Yeah, you do have to sort of look at the bigger picture, I suppose. I would say from my clients for years, don't just focus on the negative thing, the tax. It does mean that your pension's growing, a lot. It's annoying that you're not getting the full impact of that, but try and take a balanced view wherever possible. And because of the option of scheme pays all being there, if it is a big number that you cannot pay, then there is always the option that you can get the scheme to pay it on your behalf.
Yeah, that's brilliant. So I think we are going to kind of cut off the questions there, because otherwise we'll be here till midnight. So I just end on this slide again. So if you want to know more about the service, that's this QR code on the left. If you want to sign up, it's the QR code on the right. just want to say thank you very much to Alex for giving up his Saturday morning. It's much appreciated, and thank you very much to my wife Jo, who's been helping yet again in the chat and sorting everything out. I keep on cutting this off too early, so I think what we're meant to do is stay in silence for 30 seconds at the end, Alex, and so it doesn't cut it off too early. But thank you very much for everyone that's coming, and if you want to watch it again, we will upload it to the YouTube. And finally, Mary and others, don't have nightmares about brown envelopes. We've just kind of got to accept it and carry on fighting these unfair taxes. But you've got scheme pays, and so it's not worth losing sleep about it. Thank you very much, all. Bye now.
Thank you, everyone.